Good morning. I welcome you to my channel GST Samvad in the today's episode. My name is Advocate Kolte. Today we are going to start a new topic, that is the ITC, input tax credit on capital goods, and the treatment of input tax credit in the case of sale, amalgamation, merger or demerger of a company or a business entity. The treatment has to be given according to the composition of the business and the type of transfer that is being taken. Now, firstly, we will consider the aspect of ITC on capital goods, which is shortly called as like old people like me like ITC on CG. Now the CG, a capital goods, in the new parlance, in the GST parlance, also include the plant and machinery. So we will see in the course of today's discussion. This concept was not originally introduced in the ITC, that as was convinced in 1986. It was only limited to the inputs. The capital goods came much later, and the old timers may be remembering that it was a great boon to the industry at that time, and the budget in which it was presented, that was taken the stock market by storm. So that was the history. But now it is a common practice that ITC includes both the thing, input as well as the capital goods. Now, firstly, we have to understand what is the meaning of capital goods. That is the legal definition. Now, legal definition of capital goods in the particular present act, that is the GST, Goods and Services Tax Act, it is defined as the capital goods are those which are capitalized in the books of account by the availer, that is the assessee. Whoever is taking the ITC on the capital goods, he capitalizes the cost of or the price of the capital goods in his books of account. Now, and particularly the emphasis now is that it should be used for his business, for the production or the manufacture of the goods or providing services for his purpose of his business. That means the capital goods which should not be used for the personal purpose of the persons who are availing, the maybe the directors, partners or proprietor or whatever. So that is the main criteria. Now, this definition is contained in subsection 19 of section 2 of the GST Act. You will find the definition there. Now, what is important is that there is an explanation below section 17, which is very important in respect of capital goods, because under this explanation, the phrase plant and machinery has been defined. Now, it is very interesting. It says the plant and machinery is the same. Basically, it is a capital goods. So it should fall under the definition of capital goods. Nextly, it says that it excludes, I repeat, it excludes the land, building or any other civil structure. B, telecommunication towers and pipelines laid outside the factory premises. These things are excluded from the definition of plant and machinery. Now, plant and machinery, it should be attached to the earth or fastened to the earth. Now, in this particular aspect, one must understand that the plant and machinery or the capital goods should be installed in the factory or the premises from where the business is carried out. And suppose when you want to remove the capital goods, it has to be severed from the earth. It should be cut down. It should be so attached to the earth that it is almost permanently fixed. Now, for any reason, the capital goods are required to be sold or removed from the factory. Much effort is required to be taken to remove the capital goods from the attachment of the earth. Now, the installations, which are the steel structures, are there. Sometimes you find that the capital goods are huge capital goods for which civil structures or supporting steel structures are required. Now, if they are so attached with the capital good that it almost form the integral part of the capital goods, in that case, such structures are also included in the definition of plant and machinery. So, this aspect to be taken into consideration while defining any particular item is a capital goods, plant or machinery or not. Now, there is another explanation which I must highlight here, that in case of a job work, when you send the plant and machinery or capital goods for some kind of job work for any reason, you are sending it out. Now there is an explanation below Rule 45. Now this is different. For earlier one I said that is under section 17. Now this is under Rule 45, which says that capital goods includes plant and machinery. So that purpose, for the purpose of job work, its capital goods includes plant and machinery, and therefore both form on the same footing so far as the sending to the job work is concerned. Now, what is the main condition for availing ITC on capital goods? Now, everybody almost is aware of this, but I should highlight the fact, because there are some new persons, people who are working for the in the field of ITC, availment of ITC. So, whenever you avail ITC on capital goods, the ITC, if you have availed the ITC on the tax paid on the capital goods, at the time of capitalizing the capital goods in the books of account, the element of tax should be eliminated or subtracted from that particular amount. The amount net of taxes is to be capitalized, not the whole amount. Earlier, when the scheme was newly introduced, the capital goods scheme was introduced, ITC on capital goods, that time it was a common mistake made by the persons, because at that time the people looking after the central excise and service tax were different, and persons or the team working in the account department were different. So that team working in the account department, they used to capitalize the whole amount, whatever is appearing in the bill. Whereas the team working for central excise and service tax, they have already availed the tax credit of the amount of the tax paid on that particular capital good. So this is a double benefit which you are deriving if you avail both the things. So this should be taken into consideration. Now there I remember in those days, whenever the department detected this type of mistake, this is an inadvertent or a mistake which causes purely because of the lack of knowledge. The department used to issue the show cause notices proposing to recover the entire amount of the stand credit, which is availed, as well as the equal amount of penalty. That was the more dangerous part. So here the tax component is only to be taken into consideration, and that tax component is not allowed as ITC if you have capitalized the whole amount. Now, the next aspect which I earlier said, that this is the one conceptual understanding of the ITC on capital goods. But what happens if the business enterprises is being sold or amalgamated or transferred to some other entity? Now in this case, what happens to the ITC? Now these capital goods which are installed in the factory, they are almost for the purpose of long-term use. They are not intended for short-term. They are intended for very long-term use, maybe years together. So in this case, the rules require that if the capital goods are removed after using, for whatever reason, if they are removed from the factory, then the removal may be for the purpose of sale or giving it to some other party for job work or whatever. The job work, there are some other different procedures that we will consider in the next episode. But let us consider if they are sold. Then what happens? Now in that case, the ITC, which is claimed by the company or the manufacturer, has to be reversed or reduced at the rate of 5% per quarter. Now, firstly, you have to consider the quarters, how many number of quarters are involved. That is typically from the date of invoice or the date of receipt of the capital goods in the factory. You should have the evidence for that the capital goods were received on the factory on so and so date. So from that, the quarters will start recognizing. So now you have to find out the number of quarters. After you ascertain the number of quarters, you have to reduce the amount at the rate of 5% per quarter. And that will be the value for a purpose of removal. Now, if the goods are sold, the capital goods are sold, there is a transaction value also available. Now the rule says that transaction value or the amount, remind that is the amount, that is not a tax, that is the amount to be reversed. Now that amount or the transaction value, whichever is higher, is to be taken as the value of the capital goods at the time of removal. And on such value, the GST is required to be paid. This is what the rule says. Now this is given in rule 40 into bracket 2, that is sub rule 2 of rule 40 of the CGST rules. Now in case of the refractory bricks, which are consumable in nature, which are typically used as liner for the furnaces, and the jigs, fixtures, molds or dies, which are again sort of consumable in nature because they require frequent replacement as compared to the main capital goods. So in these cases, in respect of these items, the transaction value is to be taken into consideration. And whatever is the transaction value, you have to only prove the transaction value. And on that transaction value, you are required to pay the GST. So that is the thing for the purpose of capital goods and their removal. Now, if, as I said, the other part is that the sale, merger or amalgamation of the business enterprise as such. In this case, what will happen? Now let me tell you, this topic covers a lot of procedural part. Number of procedures are involved, particularly after the GST system or GSTIN has come into place. So I will not be covering the entire part because that is left to the procedures. But conceptual understanding, I would like to have some discussion on that. Now, the most important aspect is that the transfer of ITC is allowed only if the transfer of business enterprise is with a specific provision for transfer of liabilities of that business. If there is no provision for transfer of liability of the business, then the ITC is not permitted to be transferred to the new owner. Suppose a company A is being sold to company B or partnership A to partnership B, whatever. Now the liabilities of A should also be specifically provided in the transfer deed or the sale deed. If that provision is there, then only the ITC is allowed to be transferred. So while drafting the sale deed, care is to be taken. Care must be taken to provide that the liabilities are also transferred. Now the procedures, as I said, are quite lengthy, and we need not deal into that particular aspect of procedures. But let me tell you that the clause for the purpose of the transfer is provided under section 18 subsection 3, that is subsection 3 of section 18, where it is specifically provided that there should be a provision for transfer of liabilities. Now then come the procedure. The procedures are largely provided under Rule 41 of the Central Goods and Services Tax Rules. And read with, there is an important circular issued by the CBIC, Central Board of Indirect Taxes and Customs. That CBIC circular number I would quote, that is 133/03/2020-GST dated 23rd of March 2020. This is the important circular which gives all the outline of the procedure to be followed in case of transfer of ITC, in the case of merger, amalgamation or sale of the business or the business enterprise. So these are not very frequent transactions. The business sale or business merger happens quite rarely, so I will not devote much of time to this particular aspect. These procedures are there. Those who are interested may refer to these provisions as well as this circular and then carry out the procedures. So I think I have covered mostly the legal part or the conceptual part of the aspect of ITC on capital goods. So I hope you must have find it useful. If you like the video, I request you to please like, share and subscribe to my channel. Thank you.